What is quantitative investing? Many people point to Warren Buffett as the greatest investor of all time, but there's a strong argument for someone else. It's a mathematician most people haven't heard of. His name is Jim Simons, and for 30 consecutive years, his medallion fund at Renaissance Technologies averaged 66% annual returns. Not 10%, not 20%, 66% per year for 3 straight decades. How? He never picked a single stock manually. He didn't read earnings reports, he didn't watch CNBC. He treated the stock market like an equation, and he used quantitative investing. Elements of this approach are now becoming accessible to private investors. Today, I'm going to explain exactly what quantitative investing is, why it outperforms traditional investing, and how machine learning has made institutional-grade strategies available to people like you and me. Let's dive in. Here's the uncomfortable truth about traditional investing. Most of it is built on emotion and guesswork. Think about how the average investor operates. They buy when the market feels safe, usually at the top. They panic and sell when it crashes, locking in losses. Then try to time the market based on news headlines. They hold on to losing positions hoping they'll recover. They sell winners too early because they're afraid of giving back gains. This isn't a criticism, this is human nature. Our brains are wired for survival, not for making optimal financial decisions under uncertainty. And even professional wealth managers aren't immune. Studies show that after fees, the vast majority of actively managed funds underperform simple index funds over 10+ years. Why? Because humans, no matter how experienced, make emotional decisions when money is on the line. The average wealth manager in the UK charges 2 to 3% annual fees and delivers 7 to 8% gross returns in a good year. After fees, you're netting 4 to 5% annually, barely keeping up with inflation. And during market crashes, you're enduring 30% plus drawdowns right alongside everyone else. There has to be a better way, and there is. Quantitative investing, or quant investing, is a completely different approach. Instead of relying on human intuition, emotions, or subjective analysis, quantitative investing uses mathematics, data, and algorithms to make investment decisions. Here's how it works. Step 1. Identify patterns in historical market data. Quant researchers analyze decades of price movements, volatility patterns, trading volumes, and correlations across thousands of securities. They're looking for repeatable patterns, mathematical relationships that hold true across different market conditions. Step 2. Build a model that exploits those patterns. Once patterns are identified, they build a mathematical model, essentially a set of rules that says when X happens, buy. When Y happens, sell. When Z happens, sit out. These rules are tested across thousands of historical scenarios to ensure they work consistently. Step 3. Automate execution with algorithms. The model is coded into an algorithm that monitors the markets 24/7 and executes trades automatically based on the mathematical rules. No emotion, no second guessing. Just pure mathematical probability. The best part? The system is designed to adapt over time as market conditions change. This is similar to the approach used by firms like Renaissance Technologies that generated 66% annual returns for 30 years. And it's how firms like Citadel, Two Sigma, D. Shaw, and Bridgewater manage hundreds of billions of dollars. They don't rely on gut instinct, they rely on data, mathematics, and systematic execution. So why does quantitative investing outperform traditional investing? 3 reasons. Number 1, it removes emotion from the equation. The biggest enemy of investment returns isn't the market, it's your own brain. Fear makes you sell at the bottom, greed makes you buy at the top, hope makes you hold onto losers too long. Algorithms don't have these problems. They execute based on probability and mathematics, not fear or greed. When the market crashes and everyone is panicking, the algorithm sees opportunity. When the market is euphoric and everyone is buying, the algorithm sees risk. It's designed to remove the emotional biases humans struggle with. Act rationally when emotions are running high. Number 2, it processes information faster than any human could. The average person can analyze maybe 5 to 10 stocks in a day if they're really digging into financials. A quantitative algorithm can analyze thousands of data points per second across hundreds of securities simultaneously. It's monitoring price movements, volatility patterns, trading volume, correlations, market microstructure, and risk exposure. And it's doing this 24 hours a day, 5 days a week, without taking breaks, without getting tired, without missing signals. Humans simply can't compete with that processing power. Number 3, it's consistent and disciplined. Traditional investors make different decisions based on how they're feeling that day. And are they confident? They take more risks. Are they anxious? They sit on the sidelines. Did they just have a losing trade? They might overtrade to make it back. Quantitative strategies are consistent. The algorithm follows the same rules every single time. Whether it's winning or losing, whether markets are calm or volatile, that consistency compounds over time. At Oxford Equities, historical performance has averaged around 4.2% monthly over the past 4 years. That might not sound like much compared to 66% annually, but here's the thing. Consistency matters more than headline-grabbing returns. 4.2% per month, compounded, turns £100,000 into £491,000 in 4 years. That's a 391% total return. Now, here's where it gets really interesting. Quantitative investing has been around since the 1980s, but for decades it was exclusive to hedge funds and institutional investors because it required teams of PhD mathematicians and data scientists, millions of dollars in infrastructure and computing power, access to proprietary market data, minimum investments of £10 million or more. That all changed in the last 5 to 7 years. Why? Because of machine learning and AI. Traditional quantitative models were static. They followed fixed rules that researchers programmed manually. But machine learning models adapt in real time. Instead of being told, when X happens, do Y, machine learning algorithms learn from market data continuously. They identify patterns that human researchers would never see. They adjust to changing market conditions automatically. They optimize themselves without human intervention. The approach is called reinforcement learning, the same AI technique used by DeepMind to beat world champions at chess and Go. The algorithm runs millions of simulated trades, learns what works and what doesn't, and continuously refines its strategy. And because cloud computing and data access have become dramatically cheaper, you no longer need a £10 million minimum to access this technology. Today, sophisticated private investors can access institutional-grade quantitative strategies with as little as £20,000. Let me show you what this looks like in practice. At Oxford Equities, we've been running quantitative algorithms trading Apple, Tesla, and Nvidia live over the past 4 years. Here are the verified results. Total return over 4 years, 391%. Average monthly return, 4.2%. Win rate, 73.9%. Nearly 3 out of 4 trades are profitable. Monthly trading volume, £50 million plus across all client accounts. And this isn't marketing. This is independently verified by third-party platforms like TradingView and TradeZella. Every trade is timestamped. Every entry and exit is recorded. The data is publicly viewable. We don't control it. We can't manipulate it. It's data that's independently tracked. Compare that to traditional investing over the same period, such as the S&P 500, roughly 60 to 70% total return with 30% plus drawdowns. FTSE 100, roughly 40% total returns with similar volatility. Average wealth manager, 4 to 5% net annually after fees. The difference is quantitative execution. The algorithm doesn't panic during crashes. It doesn't get greedy during rallies. It just follows mathematics and data 24/7 without emotion. So that's quantitative investing. It's one of the approaches hedge funds have used to outperform over time. And thanks to machine learning and cloud computing, it's now accessible to sophisticated private investors with £20,000 or more. If you want to learn more, I've linked resources down below this video covering our verified performance, how the algorithms work, and answers to common questions. And if you'd like to see a live demonstration including third-party verified results and how it it connects to your brokerage, you can schedule a consultation using the link below. Thanks again for watching, and I'll be seeing you in the next video.